Let me tell you something about Lehman Brothers. It wasn't some reckless startup that flamed out. It was one of the oldest investment banks in America, a firm that survived the Civil War, the Great Depression, multiple market crashes, and more political cycles than most countries. Lehman didn't just participate in Wall Street, it helped define it. When I first started studying the industry, Lehman was held up as proof that a smart, aggressive bank could outgrow almost anything. But survival creates confidence, and confidence can get loud enough to drown out reality. The public version of the story is simple. Lehman made bad bets on mortgages, the market turned, and the bank collapsed. But that's the children's version. The real story is much uglier, and much more interesting, because the seeds of Lehman's destruction were planted decades before 2008. Here's something most people have no idea about. Lehman's culture was built on internal competition so intense, some employees compared it to a battlefield. Promotions weren't earned quietly. You fought for them. People who hesitated didn't last. And at the top of that culture stood Dick Fuld, a man so relentless that inside the firm they called him the gorilla. Fuld didn't just want Lehman to win, he wanted it to dominate. And he didn't forgive weakness. In the early 2000s, that mindset paid off. Lehman made huge money in fixed income, especially mortgage-backed securities. They weren't the only ones. The entire street was drunk on credit. But Lehman leaned into it harder than almost anyone. They loaded up on long-term mortgage assets, convinced they understood the game better than their competitors. And here's the twist. They actually did. At first. Lehman was early to structured finance. They hired some of the smartest quants in the industry. They built models that could dissect mortgage pools with surgical precision. From the outside, it looked like Lehman had cracked the code. But internally, there was a shift no one outside the bank could see. Risk management wasn't just ignored, it was sidelined. If your analysis didn't support the desired trade, your voice didn't matter. That wasn't official policy, but everyone knew how the game worked. You either supported growth, or you got pushed to the margins. Around 2006, a few analysts inside Lehman noticed that subprime mortgages were performing worse than expected. They raised concerns. Not dramatic ones, just quiet observations that something wasn't aligning with historical patterns. Those concerns didn't go anywhere. The mortgage machine was too profitable to slow down, and Lehman had already committed itself so deeply to the trade that stepping back meant admitting vulnerability. Lehman never liked admitting anything. Here's a little-known detail. Lehman's balance sheet was far more fragile than it appeared. They used short-term borrowing, overnight money, to finance long-term illiquid assets. Anyone in finance knows this is a time bomb. Stopping that funding, even for 24 hours, could suffocate the bank. But Lehman kept expanding the position anyway. By late 2007, the market was cracking. Bear Stearns was bleeding. Hedge funds that had never shown a losing quarter were suddenly shutting down. The street could feel the tension, like the air before a storm. But Lehman still told the world everything was fine. Their quarterly presentations were almost surreal in their optimism. They insisted they had minimal exposure. They insisted their models were accurate. They insisted the downturn would pass. Meanwhile, inside the firm, panic was slowly spreading. One of the strangest, least discussed facts is that Lehman actually did try to raise capital early enough to survive. They reached out to the Korean Development Bank. They talked to private equity firms. They even explored selling a large stake at a discount. But the negotiations fell apart for one reason. Lehman refused to admit how bad the situation really was. When you hide the truth long enough, investors assume the truth is worse than your worst confession. What finally killed Lehman wasn't the mortgages themselves. Plenty of firms held toxic assets. The difference was that Lehman didn't have the trust of the market when things began to fall apart. When confidence disappears, leverage becomes a guillotine. In early 2008, there were already rumors on the trading desks that Lehman's internal numbers didn't match reality. Counterparties started demanding more collateral. Repo lenders tightened terms. It happens quietly at first, a slightly higher haircut here, a shorter tenor there. But inside a highly leveraged bank, those quiet changes feel like walls closing in. When Bear Stearns collapsed in March, Lehman publicly insisted they were different. Better risk controls, stronger balance sheet, the usual script. But inside the industry, we all knew Bear's death wasn't an isolated failure. It was the first domino. The difference was that Bear got a lifeline. Lehman wouldn't. Here's a detail almost no one outside finance understands. A bank doesn't die when it runs out of money. A bank dies when people believe it will. Lehman's downfall accelerated the moment clients began pulling cash. Prime brokerage balances shrank. Trading partners shifted flows to other banks. You can survive bad assets for a while. You can't survive a run. By the summer of 2008, Lehman was basically sprinting between burning buildings with a water bucket. Every earnings call was a performance. They sold pieces of the business. They marked down assets at a pace that always seemed a little too slow. They announced capital raises that felt more like desperation than strategy. Then, they tried to do something bold, spinning off their toxic real estate division into a separate company, like a surgeon trying to amputate a limb after the infection already hit the bloodstream. Investors didn't buy it. Inside the firm, morale was collapsing. Some traders openly questioned whether their positions would even settle if the bank failed. Others tried to transfer positions out quietly. Even senior executives started taking meetings they wouldn't have taken months earlier. People felt the ground shifting. In September, when the Korean Development Bank walked away from negotiations, that was the moment most insiders knew Lehman was finished. But the public didn't know it yet. The final blow came when the U.S. Treasury and the Federal Reserve refused to provide a rescue package. That's the part that surprised even seasoned veterans. Bear Stearns got saved. Fannie and Freddie got saved. AIG would get saved. But Lehman, for reasons we're still arguing about, was left to die on the floor. On September 15, 2008, the announcement hit. Lehman Brothers filed for bankruptcy, listing over $600 billion in debt. Still the biggest corporate bankruptcy in U.S. history. If you weren't working in finance at the time, it's impossible to describe what that morning felt like. The entire system froze. Trading screens lagged. Counterparty lists were rewritten in real time. Some hedge funds couldn't access collateral. Money market funds broke the buck. Interbank lending evaporated. It wasn't panic. It was paralysis. Here's something the public never sees. That week, I know people who slept in their offices because they didn't know if the financial system would still be functioning the next morning. The collapse of Lehman wasn't a headline. It was a shockwave. And the strangest part? Lehman's failure wasn't inevitable. If they had raised capital earlier, if they had been honest internally, if their culture valued transparency instead of performance theater, the bank might still exist. What destroyed them wasn't one bad decision. It was years of convincing themselves they were bulletproof. That's the real lesson here. A financial institution doesn't collapse because of risk. It collapses because it refuses to admit the risk exists. Denial kills faster than leverage. Lehman Brothers survived 158 years of American history, but couldn't survive its own ego. And every time I look at modern markets, with all the leverage, the speculation, the aggressive optimism, the same patterns show up again. New names, same behavior. Before you go, make sure you subscribe. This channel exists to break down financial events the way insiders understand them, with clarity, honesty, and without the excuses Wall Street likes to hide behind. More deep dive stories are coming. By late 2007, the market was cracking. Bear Stearns was bleeding. Hedge funds that had never shown a losing quarter were suddenly shutting down. The street could feel the tension, like the air before a storm. But Lehman still told the world everything was fine. Their quarterly presentations were almost surreal in their optimism. They insisted they had minimal exposure. They insisted their models were accurate. They insisted the downturn would pass. Meanwhile, inside the firm, panic was slowly spreading. One of the strangest, least discussed facts is that Lehman actually did try to raise capital early enough to survive. They reached out to the Korean Development Bank. They talked to private equity firms. They even explored selling a large stake at a discount. But the negotiations fell apart for one reason. Lehman refused to admit how bad the situation really was. When you hide the truth long enough, investors assume the truth is worse than your worst confession.